Every era builds its own illusion of free money. In one age, it was land that always went up. In another, it was dot-com stocks that could never fail. Today, one of the quietest and most dangerous illusions isn't on the front page of the news. It hides behind jargon, currency codes, and interest rates. It's called the carry trade. On the surface, it sounds almost too simple to be important. Borrow money where it's cheap, put that money where returns are higher, keep the difference. No factories, no new products, no actual creation of value. Just a spreadsheet, a trading account, and the belief that the conditions that made this trade possible will always be there. For years, hedge funds, global banks, and even ordinary households have been playing this game, especially with currencies like the Japanese yen or the Swiss franc. They borrow in a currency where interest rates are close to zero, then flip that borrowed money into bonds, stocks, real estate, or higher yield currencies somewhere else. As long as nothing big changes, the trade prints money. Then one day, something shifts, and when it breaks, it doesn't break gently, it breaks fast. That is the real meaning behind borrow cheap, break fast. The first half of the story is about comfort, calm, and steady gains. The second half is about what happens when the illusion of stability evaporates, and everyone tries to rush through the same narrow doorway at once. To understand how we got here, you have to step back from today. ICASM as flashing screens and look at the world that existed before currencies floated. For centuries, money was chained to something solid, gold, silver, or a fixed exchange rate. Governments didn't want their currencies swinging wildly day to day. Stability was the goal, or at least the promise. That began to crack in the 20th century, and by the 1970s, the old system finally gave way. Major currencies started to float. Their values were set not by decree, but by markets. At first, it looked like chaos. Exchange rates jumped around as traders and governments tried to figure out what anything was worth. But where most people saw confusion, the financial world saw something else: opportunity. If some countries would keep interest rates low to fight deflation or stimulate growth, while others kept rates higher to control inflation, there would always be a gap. One place to borrow cheaply, another place to earn more, a spread to exploit. The modern carry trade was born not because someone invented it in a lab, but because the new rules of the game almost guaranteed it would appear. In the 1980s and 1990s, Japan became the textbook example. After a massive asset bubble burst, Japan fell into a long period of slow growth and deflationary pressure. To keep the economy afloat, the Bank of Japan cut interest rates again and again until borrowing in yen was almost free. At the same time, other parts of the world had higher rates and faster growth. The yen became the perfect funding currency. You could borrow it at near zero, convert it to dollars, euros, or emerging market currencies, buy higher yielding assets, and pocket the difference. Imagine it in simple terms. A friend offers you a loan at 1% interest. Your bank pays you 5% on a special deposit. You borrow $10,000 from your friend, put it straight into that account, and you've just locked in 4%, at least on paper. Now, replace your friend with the Bank of Japan. Replace your bank account with US Treasury bonds, Australian government debt, or Brazilian assets paying much more. Replace 10,000 with 10 billion. That is the carry trade. For a while, it feels insultingly easy. Month after month, quarter after quarter, the numbers line up. The interest you earn comfortably exceeds what you pay. Reports show smooth, steady returns with very few bad days. It starts to look safe because nothing obvious blows up. Stability itself becomes part of the sales pitch, and that is exactly where the danger begins. Carry trades are built on a long list of unspoken conditions. Interest rates in the funding currency must stay low. The currency you're borrowing must not suddenly strengthen. The assets you're buying must not collapse in value. Volatility must stay contained. Fear must stay manageable. Liquidity must remain available. In simple language, the world is allowed to shake a little, but not too much. Over time, this quiet profit machine attracts more and more players. Large hedge funds pile in, using leverage to multiply the modest interest rate gap. Banks join in, using cheap funding to pad trading desks and proprietary books. Pension funds, searching desperately for yields to meet promises they probably never should have made, find ways to tap into the same trade. In some countries, households even get dragged in, taking loans in foreign currencies to capture lower interest rates. They all look different on the surface, but underneath, they are doing the same thing. Borrow cheap. Reach for yield. Pretend that the assumptions holding it all together are so normal they barely deserve a second thought. On the way up, this creates a feeling of calm inevitability. The profits come in slowly and quietly. The risk doesn't announce itself. It hides in the background, waiting for a trigger, a policy change, a crisis, a shift in sentiment. And when that trigger arrives, the same features that once made the trade seem safe turn on their creators. The 1990s gave a brutal demonstration. The yen carry trade had grown enormous. Investors borrowed in yen, sold those yen for dollars, and bought higher-yielding assets around the world. As long as the yen stayed weak and the Bank of Japan kept rates pinned near zero, the trade seemed like free money. Then, Regional crises in Asia and Russia shattered the illusion of calm. Suddenly, assets that had been happily soaking up cheap yen funding were plunging in price. Investors who had felt clever and conservative found themselves staring at mounting losses. The instinctive reaction was the same everywhere: unwind the trade. Unwinding a yen carry position means selling the assets you bought and buying yen to repay what you borrowed. When a few players do this, the market absorbs it. When almost everyone tries to do it at once, something else happens. Demand for yen spikes. The currency surges in value. The very move that investors feared becomes reality, and it feeds on itself. As the yen strengthens, the losses on existing carry positions get worse, forcing still more players to cut and run, buying even more yen in the process. That feedback loop is what break fast really looks like in practice. A trade that generated gentle, almost boring returns for years suddenly delivers catastrophic losses in weeks. The same flows that once supported asset prices now crush them. The same currency that made borrowing cheap becomes a wrecking ball. This isn't just a story about hedge funds staring at screens. Ordinary people have been dragged into their own version of the carry trade without ever learning the word. In countries across Eastern and Central Europe, for example, banks once marketed mortgages and loans denominated in Swiss francs. The sales pitch was simple and seductive. A loan in the local currency might come with an interest rate of 6 or 7%. A loan in Swiss francs might carry 2 or 3% instead. The Swiss franc had a reputation for being stable and safe. For families dreaming of a home, that lower rate looked like a gift. On paper, it was the same basic pattern as any carry trade. Borrow in a low-interest, strong currency. Pay it back over time using income earned in a different, weaker currency. As long as exchange rates stayed stable, the math worked. Monthly payments were manageable. The illusion of a smart decision hardened into a feeling of security. Then, the global environment changed. Local currencies weakened. The Swiss franc strengthened. In some cases, currency pegs and policies that had kept the franc contained were abandoned in a single decision, causing sudden, massive moves. Overnight, the amount of local money required to cover the same Swiss franc mortgage exploded. People who had once been comfortably making payments found themselves crushed under debts that had effectively doubled or more in their own income terms. They hadn't opened trading terminals or studied carry trade strategies. They had simply taken the lower rate offered by their bank. But the underlying risk was identical. Their income and their debt lived in different currencies. Without meaning to, they became the funding leg of a global trade, betting that a foreign currency would stay quiet forever. The math did not care that they didn't know the vocabulary. The result was the same. The real threat behind carry is not just interest rates, it is volatility. Most of the time, carry strategies earn a small, steady return in exchange for taking on the risk of large, occasional disasters. It is the financial equivalent of picking up pennies in front of a steamroller. You really do pick up the pennies. They are real. But so is the machine coming up behind you. When markets are calm, nothing appears to be wrong. That calm itself becomes part of the justification. People say things like, "It has been stable for years," as if that were an argument rather than a warning sign. But under the surface, pressure builds, leverage increases, positions grow larger, complexity rises, and everyone starts to quietly rely on the assumption that whatever shocks the future holds, they won't touch the particular currency pair or bond market they happen to be using. When that assumption fails, the mechanics are always similar. Currencies move sharply, either because a central bank changes policy, a crisis shifts money flows, or confidence breaks. Assets bought with borrowed funds drop in value. Lenders get nervous. Margin calls start to hit. Borrowers must either add more collateral or liquidate their positions. They sell into a falling market, pushing prices down further. Each wave of selling triggers the next. Losses that looked manageable on day 1 become existential on day 10. From the outside, it can look like sudden madness. Headlines talk about panic, but it's not madness. It's math, leverage, and human behavior all snapping into alignment at the same time. What makes this worse is that modern monetary policy quietly encourages the growth of carry. When a central bank pushes its own interest rates to the floor and promises to keep them there, it is doing more than helping homeowners refinance. It is signaling to the entire financial system that borrowing in that currency will be cheap and predictable. The lower the rate, the more tempting it becomes to use that currency as funding for all kinds of strategies. At the same time, when central banks in other countries keep rates higher, or when governments run large debts that must be financed at yields above zero, they create the destination leg of the trade. Money borrowed cheaply in one place goes hunting for better returns somewhere else. Government bond markets, corporate bonds, property, dividend stocks, speculative assets, all become magnets for this flow of borrowed money. From a distance, it looks like a kind of harmony. Low rates in one country, higher yields in another, seemingly stable currencies, rising asset prices. Politicians praise the health of the market. Central bankers point to calm conditions as proof their policies are working. Beneath that calm, the web of carry grows thicker. None of this means the trade is evil or forbidden. Carry is a natural outcome of differences in interest rates and exchange rates. But history's message is simple. When enough of the system starts to lean on the same assumptions, those assumptions become points of failure. You do not need to be running a multi-billion-dollar currency book to be caught in this. Anytime you borrow cheaply to invest in something you think is almost guaranteed, you are flirting with your own version of the carry trade. A homeowner who constantly pulls equity out of a rising house price to buy more property because real estate always goes up is playing a carry game. Their funding is cheap mortgage debt. Their asset is the expectation that prices will never really fall in a serious way. An investor who uses margin to double or triple exposure to stable, high-yield securities because they've barely moved in years is running a carry strategy. Their funding is the broker's loan. Their profit is the extra yield. Their risk is that stability is not a law of nature. Someone who takes a loan at a low fixed rate to buy cryptocurrencies or speculative stocks because this is a once-in-a-lifetime opportunity is doing the same thing in a more volatile costume. Borrow to buy. Hope the gap between borrowing cost and expected return stays wide and positive. Ignore the possibility that reality has other plans. The principles do not change. Only the labels do. The most useful question you can ask before you step into anything that looks like easy yield is disarmingly simple. What has to stay true for this to keep working? Does a central bank have to keep rates low forever? Does a currency have to hold its value no matter what? Does a market have to stay liquid and calm even under stress? Does a particular asset class have to keep rising just because it has in the past? Then ask the second question. What happens to me if that condition breaks? Not in theory, in numbers, in cash flows, in the reality of bills, savings, and obligations. If the honest answer is that the situation becomes unmanageable very quickly, what you're looking at is not a safe, clever strategy. It is a carry trade with a fragile foundation. Free money is never free. At best, it is deferred risk. The interest rate gap is your reward for holding a bomb that may or may not go off while you are still holding it. Every era tells itself a story about having tamed danger, about having finally built a system where crises are less likely, smaller, more controlled. Every era uses that story to justify more leverage and more faith in trades that depend on nothing important changing. History has already delivered its verdict on that kind of thinking. Empires that debased their currency to fund wars learned it. Investors who believed certain institutions were too big to fail learned it. Families who trusted foreign currency mortgages learned it. Each believed they had found a way to borrow cheap without ever facing the break fast part of the equation. Each discovered that you can postpone the moment of truth, but you cannot erase it. The phrase carry trade, borrow cheap, break fast, is not just a description of a niche financial strategy. It is a warning about a mindset. The temptation to treat low borrowing costs and apparent stability as permanent features of the world is powerful. But the world does not sign contracts promising to stay quiet just because you need it to. In the end, the pattern repeats. For years, conditions look favorable, and strategies that depend on those conditions thrive. More people copy them. More money flows in. The trade becomes crowded, embedded, taken for granted. Then something small goes wrong, amplifies through leverage, and the unwind begins. Those who understood the nature of what they were doing and kept their exposure survivable may walk away, bruised but standing. Those who believe in the illusion of free money discover that the bill has come due. The question is not whether carry trades will continue to exist. As long as there are different interest rates and floating currencies, they will. The question is whether you choose to become another believer in free money, or someone who recognizes that every extra % of yield comes with strings attached, even if they are invisible at first. When the next big carry trade cracks, it will look sudden to most people. It will be described as a shock, a crisis, an unpredictable event, but the seeds will have been sown years before, in quiet decisions to borrow cheap and hope the world never changes. If this gave you a new perspective, subscribe. History has the answers. I'll show you where to look.